Great. Let's get started. I'm Scott Simmons. I'm a bank insurance consultant, an insurance consultant, and I'm very glad that you've joined us today. You should have a copy of the slides that I'm using. I don't believe I've changed them since I sent those out. I think you should have the current version, so you can follow along and take notes. This session for insurance agents who want to learn about bank insurance. What we're going to say today is going to stay pretty much at 25,000 feet until question time at the end, and then I'll get into some specifics. Again, I am very glad to take questions during the session, but you'll need to email them to me. My email address is on the screen, scott@scottsimmons.com. They should come to me right away, and I'll be very glad to answer them as we go through this. I decided to do this a couple of weeks ago. Maybe a month ago, came up with the idea for it. So this is kind of a flyer for me. I've never done anything like this. I get 3 or 4 phone calls every week from insurance agents who work with banks based upon the information that they find on the internet about me and my work in banks. And so I thought that this might be a good opportunity to answer some of the questions that normally come up, and also to share the approach that I take to bank insurance when I'm working with a banker. So I'm going to talk to agents. We have some insurance company people on the phone. We also have some insurance company, insurance agents, and bank folks here with us. First, an observation: if I look at the agents that have signed up for this session, just the agents, not the company people. At this point, it looks like about a third of the folks on the call are with insurance companies. So if I just look at the agents, the agents on this call represent about 1,500 banks around the country, based upon the information that was provided to me when you guys signed up. 1,500 banks. Now, there are about 6,000 banks that I would consider community banks. Less than a couple $1 billion, 7,000. So we have roughly 25% of the banks in the United States represented on this call, and I'm blown away by that. Quite frankly, I figured we'd have 10 agents on the call, and that would do it. Let me first start out by suggesting some resources that I'm working on building. And these resources are available for anybody who wants to go on the websites. The first is uofbankinsurance.com, and that includes a broad range of videos, white papers, articles that I've written, editorials that I've written to trade magazines, some articles that I've done for bank associations. So take a look at that and use that as a resource, please. And the second is my blog, insuranceassuranceblog.com. You can also access that by going to my website, scottsimmons.com. And I post on the blog, 4 or 5 times a month, sometimes a little more, but usually at least 4 times a month, on various issues that I'm interested in and think that my readers will be interested in. The blog is obviously read by bankers, agents, and insurance company people. The tone tends to be for insurance buyers, so that's primarily my focus. But I think you'll find that there's some things there that might be thought-provoking. You are also free to use any of the material on either of these websites or on my main website with your clients. Of course, I would like you to attribute it to me. All of the material is copyrighted, but you're free to use it, again, with attribution. Point your clients to this if you think that they'd find a video helpful or other information piece, so feel free to distribute that. Good, so let's get into bank insurance. I find that if I divide bank insurance into 4 sections, that my clients are able to keep things straight. One of the problems with bank insurance is that it's confusing. And bankers who are dealing with insurance are working in the insurance marketplace once a year and quite often once every 3 years. So I call it a cyclical learning curve. So the bankers, the CFOs, and the chief risk officers and the CEOs that I work with, they learn about bank insurance. We talk about things, and then they move on to other stuff. And then a year later or 3 years later, we come back to it, and we end up again going over that same material. So I divide bank insurance into 4 sections: executive risk, fraud bond, standard lines, and lender asset protection. So let's talk about each one of these items. And again, I'm going to talk as I generally talk to bankers about these items. The executive risk liability, bankers often call this D&O insurance. They talk about their D&O insurance. And obviously, that's a part of executive risk coverage. So I try and gently correct bankers into looking at this contract or at this coverage section as the executive risk liability policy. It includes directors and officers, D&O coverage, lender liability, bankers' professional liability, fiduciary liability. I put cyber liability in here as well. Employment practices liability insurance is here, trust, errors and omissions. If a bank has an insurance operation, there might be insurance agents, errors and omissions, or broker-dealer errors and omissions coverage here. So the executive risk liability section. One of the key things that I focus on with my banks about this section of bank insurance coverage is the idea that this is a third party coming after you. There are almost always lawyers involved. Somebody's coming after you through their lawyer because of a wrongful act that you have allegedly committed. And that's a key distinction between some of the other coverage areas. So in executive risk liability, almost always a lawyer is coming after you, you're being sued. Now, I use the phrasing fraud bond to describe the financial institution bond, or what many agents still call the banker's bond. I came up with the idea of calling it the fraud bond a couple of years ago when it occurred to me that this may be the only insurance policy that I've ever worked with that doesn't have a descriptor in the name. When your clients, as an agent or an insurance company, when an insured looks at a homeowner's insurance policy, it says homeowner's insurance at the top of the policy, and they know it insures their house. Auto insurance, workers' compensation insurance, property insurance, general liability even has a bit of a descriptor in there. D&O insurance. You know, we can look at the policies, just the name at the top of the policy, and we can understand what that's supposed to cover. What's a bond? To the average insurance buyer, the word bond is meaningless. And quite frankly, as the insurance industry, we don't know what a bond means. We're using it here to mean sure, and the same term is used in surety, which of course is very different that we're talking about here. So I've added the descriptor fraud bond. Whenever I'm talking to a bank, I call this policy the financial institution's fraud bond, because almost every coverage within this coverage section, every coverage within this policy has to do with some aspect of fraud committed against the bank. It's a first-party coverage. We're protecting the assets of the bank for an event that involves some form of fraud. And the other distinguisher that I use in describing this is almost never is a lawyer involved in coming after you for a fraud bond claim. So if you get a demand letter, if a banker gets a demand letter from an attorney saying you've messed up in some way, the banker can almost instantly assume that we're not going to be in the bond when we look for coverage, at least initially. Now, there certainly are claims that involve the bond and the, and the management liability, executive risk. But you know, we're trying to describe this coverage to non-insurance people, and almost never is a lawyer involved in coming after you for a fraud bond claim. The fraud bond includes employee dishonesty coverage, robbery, safe depository, funds transfer fraud, computer fraud, and debit card fraud. So we've talked about executive risk liability. We've also talked about the fraud bond. The third area, broad area of coverage that a bank would purchase is standard lines of coverage. And I describe this to my bank clients as being the same insurance that virtually every business buys. The standard lines of coverage is, in its essence, no different for a bank than it is for a law firm, than it is for a grocery store or a hotel. We've got property insurance, we've got general liability insurance, we've got auto, workers' compensation, umbrella liability. Now, we certainly fine-tune those policies so that they respond to the risk of banking, but the policies themselves are common to the business community. The fourth and final area of coverage is what I call lender asset protection. And these are these policies, quite frankly, to most retail insurance agents are a bit of a mystery. And I admit to struggling with some of these issues as well. The lender asset protection policies are foreclosed REO property insurance, force-placed insurance, force-placed flood, mortgage impairment, lender's single interest coverage. The key issue here is that these are policies that are protecting the bank's interest, its security interest, in the collateral that's used to secure a loan. So mortgage impairment provides protection to the bank from the mistake of missing that there's no insurance on a particular mortgaged property. REO protects the bank when they've foreclosed on a property. REO, by the way, means real estate owned. Sometimes it's called other real estate owned in the banking world, but it's foreclosed property. Force-placed insurance is when a bank is in a situation where they know that there's no coverage on a particular mortgaged property, and so they force the placement of insurance on that particular piece of property. So, again, the four areas of broad areas of bank insurance are executive risk liability, the fraud bond, standard lines, and lender asset protection. Now, there are a couple of other policies that we get involved in and that we work with. The stamp bond is a signature guarantee. It's used in securities transactions. It's used when a bank has to guarantee that the signature on a security is accurate. They are warrantying that it is in fact the right person, and that is closer to a traditional bond or a surety bond, in that there is an indemnification provision within that, so that if a claim is made on the stamp bond, that the surety can go back to the bank for reimbursement on that. Now, we have 115 people on the call right now. I'm blown away. Employed lawyers coverage. This isn't really a bank issue, and I frankly don't have a lot of banks that have employed lawyers insurance, but I do like to talk about it when there is a situation where a banker has a lawyer that's working for the bank. I know some of my clients, the CEOs of the banks, are attorneys by training, perhaps not by practice, but by training. Some of my bank clients have in-house counsel that they use. Some just have attorneys that have, or people working for them that happen to be attorneys. Again, not practicing. And the distinction that I want to make to my clients is the idea that if those individuals are acting as attorneys, doing attorney work, doing legal work outside of their work for the bank, that the bank's insurance policy is not going to respond to a liability claim. So, for example, if the in-house counsel of a $750 million bank does a will for his next-door neighbor, and that ends up in a lawsuit against the attorney, that attorney, who is an employee of the bank, can't expect the bank's insurance to follow along with that. If an attorney's work is in connection with their work at the bank, then obviously the bank's insurance follows them along. If they're doing some title work or doing some real estate work for the bank, obviously as an employee, the professional liability coverage and the other insurance coverages, the broad insurance coverages would apply. But in most cases, the liability insurance is only going to follow that individual for when their work has a connection to the insured, to the bank. So a couple of other policies. that I talk about with my clients. This is the bank insurance marketplace from my perspective. There probably are other insurance companies. I offhand, when I created this, I couldn't think of another insurance company. I know we've got people on the line from most of these insurers, and certainly agents. And I know somebody will send me an email if I've missed somebody. These are both major league players and minor league players in the bank insurance marketplace. I'm going to hurt some feelings, but right now, in my mind, the key players, the most aggressive players in the marketplace are Travelers, ABA, FinSecure. CNA does a nice job, and I've worked with them on many banks. So I wish them well, and I want to see them be more aggressive on a broad range of banks. OneBeacon has worked on many of my clients. Unfortunately, they have missed more than they've hit. But again, I hold that someday perhaps they'll be more aggressive and more competitive. And they may be on other banks. I'm just not seeing it. AmTrust is a very interesting insurance company. I know we've got some folks on the call from AmTrust. There was an insurer called Bank Insure who struggled. This was a small insurance company, and it struggled for a couple of years, and then maybe 2 years ago, AmTrust bought the expirations or the renewal rights. I'm probably not saying that exactly correct. My understanding is they didn't assume liabilities, they just took over the assets. And I held off judgment on them. I've written several banks with AmTrust over the last 6 months to a year, and I've been very pleased by the work that they do. So insurance agents, these are the carriers that I see as being major players. The Cincinnati has recently cut back on what they're doing with larger banks. I believe their line is $1 billion, and it might be $500 million. I just don't have my notes in front of me. Cincinnati does a fine job. I've talked about FinSecure. They're certainly one of the leaders currently in the marketplace. I believe they're pretty much in every state now. They are probably with ABA one of the carriers that I see as most successful right now. Zurich was a market leader for a very, very long time. I have not seen them as being particularly competitive of late, though I, again, hold out hope. ABA Insurance used to be called Progressive. I don't know, 5 years ago now. There was a change in the structure of the company. Many of the same people stuck around, and the program continues to be underwritten by the Everest Insurance Company. Everest was involved in Progressive as well, and I've always held this program in high regard. The coverages, by and large, are exceedingly broad. ABA Everest, ABA Insurance Services agents, if you're looking for this, if you Google ABA Insurance, you'll find it. I've talked a little bit about OneBeacon, and I've probably got some people grinding their teeth right now. I have a special place for OneBeacon because my father worked for its predecessor company, Commercial Union, for about 35 years, and I'd like to see them be successful and be more competitive. I've talked about AmTrust. Chartis, the old AIG, is more on the side of a market of last resort for banks that are in trouble, in my mind, though they do have an exceptional program in the debit card arena. I use them a great deal. Their program is called the Bank Card Protector, and it segregates the coverage out of the bond on debit card fraud losses, plastic card losses. They do a great job with that. The coverage is quite broad. Their deductibles are relatively low. The problem with debit card coverage within the bond is that it tends to hold a high deductible. And if you talk to your banking clients, they'll tell you that debit card losses are often death by 1,000 cuts rather than a large loss. So look to Chartis for that. It's almost a universal recommendation now for me to suggest that a bank consider the Chartis Bank Card Protector program. Lloyd's obviously is a place for banks that are in really tough shape, having a tough time of it. They also are the paper behind Beazley. Beazley is a specialty insurer. I use them extensively in cyber liability and the e-risk, the e-banking insurance side. Again, an almost universal recommendation for me is for my banks to consider buying insurance from Beazley for the cyber liability coverage. I'm a real fan of that. We'll talk a little bit about that in a couple of minutes. Travelers always, for a very, very long time, has done a nice job with banks. They, like many of the carriers that we've talked about, will write the entire bank account. Travelers seems to do best when there's competition. I like on a renewal to make sure that Travelers is facing some form of competition. And again, I'm sure there's some people gritting their teeth right now over that comment, because I know we've got some Travelers folks and Travelers agents on the call. CNA, good company, really just entered the bank marketplace, what I would consider earnestly a couple of years ago. They've built themselves a reputation, and I think they're trying to fight this reputation, but they've built themselves a reputation of doing a fantastic job on banks that are on the downside of trouble. So a bank that financially has had some hard times, but are coming out of it and are maybe has changed management, has changed the structure, had an infusion of capital, but the bank is coming back from a time when there has been trouble. CNA does an exceptional job there. But again, I'd like to see them on the banks that are continue to become more and more competitive on good banks that have always been good. Chubb is a bit of a disappointment for me as well. Chubb is a solid carrier. I like them very, very much, but I have not seen them be as competitive as other insurers. So this would be another carrier where, in general, I'm just not seeing them step up when they're facing competition. With Chubb, I often have trouble getting the limits of coverage that I think I need. I'll be looking for $5 million executive risk coverage, and they'll offer $3 million, which isn't always real helpful. But again, a solid insurer, a good insurer, I just would like to see them more competitive. While we're talking about the marketplace, let me just talk about my position about the insurance marketplace. What I say to my bank clients is that I want the bank insurance marketplace to be robust. I want a lot of players. I like it that we've got this many insurers playing in the bank field, because competition helps the insurance buyer. It helps the insurance buyer get better coverage. It helps the insurance buyer get a better price. It also helps the competing insurers. We all do better when there's competition, my opinion. And so what I say to bankers is I want a lot of players, I want a robust marketplace, but I want them all to hate each other. I want FinSecure to be gunning for Zurich. I want OneBeacon to be gunning for ABA. I want CNA in there swinging when it's Travelers on the other side. So there you have my marketplace comments. Again, if you have questions about anything that I'm talking about, please feel free to email me, scott@scottsimmons.com. I alluded to this next issue a little while ago when I first started talking about management liability, executive risk liability, and the fraud bond. This is a very common area of confusion amongst CEOs, CFOs, and risk managers at banks, the people that are buying insurance in the smaller banks. What's covered by the bond? What's covered by the management liability or executive risk liability coverage? And as I said before, the distinguishing characteristics that I use is that the fraud bond is a first-party policy. It's covering the assets of the bank. The reason that the bank has lost assets is because of fraud, and there almost never is a lawyer coming after the bank in a fraud bond claim. So that's how I distinguish the fraud bond. Management liability, executive risk, there is a lawyer involved. You're being sued over some issue where you have committed a wrongful act. There's no bodily injury. There's no property damage. That's the general liability in the auto policy. But you're being sued for something that you've done within the bank. And then I talk about D&O claims, and I talk about employment practices liability, and issues like that. So when you're talking with your banker clients, talk about these two areas and address it head on right at the very beginning of the conversation. And what I find when I'm reviewing coverage for a bank, that if I talk about this particular issue at the beginning, inevitably we come back to it. So there'll be a question of coverage or there'll be a question of a hypothetical claim, and I can come back to this idea again of the difference between the fraud bond and the management liability, and I can walk them through it, and it tends to help, again, avoid confusion. The most common question I get as an insurance consultant is how much insurance should we buy? And it is a question that I wrestled with when I first started my consulting practice. It'll be 14 years next month that I've been working as a consultant rather than an agent. I was an agent for 20 years. What I came up with was the idea that I would provide a specific recommendation as to the minimum limits of coverage. And each of you should have gotten a copy of my latest matrix, and you'll see there that I review all areas of a bank's insurance, and it's segregated by asset size. So the larger banks are going to need a higher limit of coverage. And when I'm discussing limits of coverage with a bank, I use this as a guide plus what I call economics. So when I'm speaking with a bank, what I talk about is the idea that this is a starting point for us, and then we have to look at the economics. So if I've got a smaller bank that has $2 million worth of D&O coverage, for example, and I think that they ought to consider $3 million, we look at the cost of the extra $1 million, the cost of going from $2 million to $3 million, or the cost of going from $5 million to $6 million, whatever the number is. And then we make an economic decision on that cost. Is this the best way to spend $5,000 or $9,000 or whatever the number is? The other thing that I say quite often with my bank clients is, if the difference in premium between $2 million and $3 million is $200, you're going to buy it. It's not real money. If it's $20,000, you probably won't buy it. If it's somewhere in the middle, you have to make a decision. So the recommended minimum limits that I provided to you and is available on my website, and I distribute it quite freely, those are starting points. They're not hard and fast. Every bank has a different situation. I have not distinguished between stock banks and mutual banks, or publicly traded banks and closely held banks with that. I quite often get asked the question about the difference. A mutual bank, in general, the liability insurance is going to be less than for a publicly traded bank. So buying higher limits of coverage makes more economic sense. They also don't have the exposure. The reason the premium's lower is they don't have the exposure of a stockholder suit. So you have to look at a variety of different issues on this to make the decision of how much insurance to buy. So let's talk about e-banking issues. Fraud issues, first of all. So these would be the broad range of cyber losses that can occur. Fraud losses, first-party losses to the bank. So a hacker gets into the computer system and moves money between branches. Between accounts. So these would be generally fraud bond issues. Hackers, fraud, again using technology to move money. There's the liability issues, the injury to third parties. That would be privacy, violation of privacy, or a customer sues the bank on the idea that they weren't able to access their funds using the e-banking system, typical liability issues. Debit card issues, I've talked a little bit about here when I was talking about Chartis, debit card fraud, and then the idea of privacy. So when we look into the liability side of this and the privacy side of this, I mentioned when we were talking about markets the idea that Beazley is an insurer that can be exceptional for banks. And the primary reason that I move my clients to Beazley or have them suggest consider moving to Beazley is the way that Beazley handles the mitigation expenses that come out of a violation of privacy. So in my mind, there's two parts to the cyber liability policy. There's the liability side that responds to a lawsuit brought against the organization for a data breach. And then there's the mitigation expenses. And the phrasing that I use with my bank clients is the idea that if a data breach occurs, we don't know if we're going to be sued or not. But what we do know is that we've got to mitigate the loss. We have to notify our clients that there is something there's something going on and that there has been a data breach. So we know the bank is going to incur expenses. The Beazley approach to that is that their coverage responds on an individual basis. So their policy, for example, would say that they will cover the notification expenses of 25,000 people, whereas the standard coverage available from most insurers, Travelers, Zurich, FinSecure, CNA, responds on a dollar basis. So you would have $500,000 or $1 million of coverage to pay for mitigation expenses. The average cost of notification for a bank is between $150 and $200 per name. That's a number that I've heard quite often in the industry. It also is a number that I've seen in claims bear out. So let's use that, $150 to $200 per name. If a bank has lost 5,000 names, we can pretty quickly outstrip the coverage if we're only looking at $500,000 worth of mitigation expense coverage. And with the Beazley program, pretty tough to run out. I worked with a small bank. I think total number of customers was like 8,000 customers, and the Beazley policy provided coverage to notify 50,000 individuals. The other reason, and perhaps the more important reason from a small bank perspective for Beazley, is the service center that they provide. What I say to my bank clients is that if they have a data breach, their second phone call is going to be to Beazley, and that they're going to work with them aggressively on managing the claim. So part of what a bank buys when they buy the Beazley insurance, cyber liability insurance coverage, is protection for or service to help with the mitigation of that loss. They're going to have their hand held. Some of you may be experienced with kidnap and ransom insurance. And when I was working with multinational companies, I always wanted my kidnap and ransom insurance for my clients to be with either Chubb or AIG. And the reason that I wanted that was not necessarily that their policies were any better than what other insurers were offering, but Chubb and AIG tended to have boots on the ground in the countries where my clients were going to be. So if there was a problem in Brazil, AIG had an office in Brazil, and they could help us get our executive back. And it's a similar issue with Beazley. Again, it's a hand-holding. Again, invite questions by email, scott@scottsimmons.com, scott@scottsimmons.com. A couple of questions have come in, and we'll talk about those in a few minutes. Civil money penalties is an issue that's been discussed more and more over the last couple of months than in the last couple of years. The idea is that within some D&O policies, there has been coverage to pay for the fines and penalties assessed against the executives, the directors and the officers, by a regulator. So the FDIC comes into a bank, they find a problem, and they decide to go after the directors and officers on that particular issue, and they try to assess civil money penalties against a bank. This has been a coverage that's been around for a long time, as long as I can ever remember. I've seen it within bank D&O policies. And one of the things that happened was that individual insurers would charge the directors or the officers a premium, and the idea was that the FDIC regulations looked askance at the idea of buying civil money penalties insurance on a bank insurance policy but if the executives paid the premium on their own, that prohibition would not apply. About 3 years ago, I started hearing some noise. I think it started with the Louisiana Bankers Association about some folks at the FDIC that were concerned about this. I had several conversations with people at the FDIC, and about a year and a half ago, I came out with a general recommendation that my bank's clients remove civil money penalties coverage from their D&O policies. And so that's been kind of my general recommendation over the last couple of years. And then this past October, the FDIC came out with a letter that removed all doubt about their displeasure with the idea of having coverage for fines and penalties on a bank insurance policy. So I've been talking a great deal lately about civil money penalties insurance, but my recommendation has been the same for a couple of years, and that's to remove it. One of my concerns before this letter was that the FDIC would assess civil money penalties against directors because they had civil money penalties insurance. I'm not aware that that has happened. I've heard some rumors that it has happened. I haven't seen any proof that it has actually happened. But with the October letter that the FDIC put out, it removes all doubt that a bank should not have this coverage as part of their insurance program. Most insurers are now removing the coverage at renewal. I thought that there was a couple of carriers that would keep it on, and I was told earlier this week that virtually everybody is now working to remove that as policies renew. I do have folks asking me about about individually insuring civil money penalties insurance. So an individual director or an officer would buy their own civil money penalties insurance policy. The FDIC in private conversations have told me that would not be a problem as far as they're concerned, at least not right now. And the idea is that what the insurance that an individual director buys is an individual's business. What they don't want is an attachment to the bank of the insurance policy. There are several brokers that are working on this. One New York broker has reserved the domain name www.civilmoneypenalties.com. I'm not aware of anybody who successfully is offering or who is currently offering individual civil money penalties coverage. I hope it'll be available. I'm encouraged. I think I've had 3 conversations with different brokers over the last week that are working on this, and I've always done nothing but encourage them, because for some directors, this is a real concern, and they really would like to see would like to buy the coverage. Executive risk buckets of coverage. When I look at an executive risk policy, one of the things that I talk about with my clients is the idea that I want segregated limits of liability within the management liability, the executive risk liability policy. So I want a bucket of coverage for directors and officers insurance. I want a separate bucket for employment practices. I want a separate bucket for cyber liability. I want a separate bucket for fiduciary. I want a separate bucket for professional and lender liability. I don't want there to be a situation where a claim for employment practices liability reduces the amount of insurance that's available to pay a future directors and officers claim. So when I look at an insurance policy for a bank that tells me that they've got $3 million of management liability coverage in one bucket, and all claims paid by that policy come out of that, I have to say to my bank clients, you've got $3 million of D&O insurance unless you happen to have a lender liability claim that reduces the amount of insurance in the bucket. The use of the word bucket seems to work very well with my clients. They can understand that you either have one big bucket of coverage or you have many smaller buckets of coverage. And the idea that removing something out of one bucket doesn't impact the amount of money available in another bucket. So there's a tool that you can use to explain coverage to your clients. Many times I work with my clients on the bid process. They're working with a particular agent, a particular insurance company. The policy is coming up for renewal, and they want to see what somebody else can do. Perhaps a customer of the bank is an insurance agent, and so from a business relationship perspective, they want to have an opportunity to have somebody else take a look at this. Quite often I recommend a bid process. Quite often I recommend against a bid process. It depends on what the ultimate objective is. The question that was asked of me, apparently, I think they misread something that I had written in the past, because the question was phrased in such a way as to indicate that I recommended that a bank bid their insurance every year. That's just absolutely against what I normally recommend. I have some bank clients who have not bid their insurance in 20 years. They renew their insurance with the same agent and with the same insurance company, and sometimes that's the best approach. I do like to involve other insurers in a competitive renewal process about every 3 years. Again, as we were talking about the insurance marketplace a couple of minutes ago, I indicated that I like healthy competition, and I find that insurers, like every other business, responds better. It provides higher value to their clients, to the insureds, when there is competition. But I certainly do not recommend every year. I quite often recommend every 3 years. I do not always recommend that other agents get involved. And many times I'll do a broker selection process where we're trying to decide if we want to use one agent or multiple agents in the renewal process. I was asked a question about regulatory actions. One of the things in the FDIC letter that I mentioned a few minutes ago that was on the civil money penalties issue, it also talked about that some bank insurance policies have an exclusion for suits brought by regulators. The regulatory exclusion is a non-starter as far as I'm concerned. I do tend to work with banks that are pretty strong. By and large, the banks that come to me are not in financial trouble. And that isn't anything that I've designed. It's just kind of the way that it's worked out in my practice, that the stronger banks seem to be the ones that call me. So I don't see regulatory exclusions all that often. I do know that once a bank starts down the path of having problems, that insurers try to put exclusions for lawsuits brought by regulators. The regulatory exclusion is a huge problem for a bank, and I, in general, urge real caution if you've got a regulatory exclusion. I did start working with a bank about 2 weeks ago, a strong bank, and the reason that they called me was they found a regulatory exclusion on their policy, and they went to their agent, and the agent apparently didn't know that it was on there. So take a look at your policies and make sure that we don't have regulatory exclusions on there. In the past, I've made comments about coinsurance on the property policy, and somebody emailed a question about coinsurance. The phrase is, your comments on coinsurance in your writing is harsh. Coinsurance promotes and encourages insureds to buy enough insurance. We avoid using agreed amount. Yeah, if you go into the bankinsurance.com, you'll see a video on coinsurance in there, and I take a pretty strong stand on a property insurance policy. From an insurance buyer's perspective, I recommend against coinsurance, and in fact, I use coinsurance quite often as a litmus test when I look at the quality of an insurance agent. In modern times, in current day, actually for the last 15, 20 years, most insurance companies are offering to remove the teeth from the coinsurance penalty. And if you ask them, in general, the insurers will do it. Perhaps we have to buy more insurance. Perhaps there's a disagreement as to what the actual insurance to value is. But if we buy enough insurance, we can remove the coinsurance clause, or at least remove the penalty. And if I see a coinsurance clause on building insurance or business personal property insurance, I start to question, quite frankly, how aggressive the agent is in looking out for the interests of his clients. I understand that coinsurance protects the insurance company. It doesn't help the insurance buyer. All right. Here's another question about the bid process. We've answered that, I think. If the bank has their own agency, or if a bank director writes the insurance for the bank, is this recommended? If not, what reasons or information do you give the bank so that they don't write the bank insurance through their agency or a bank director? So I've worked with 300 banks around the country, well over 300 banks around the country, and in about 80% of the circumstances for banks under $1 billion, there is some form of incestuous relationship with an insurance agent, and I say that tongue in cheek. I've seen everything from the bank owning the insurance agency to the insurance agent being the president of the bank's wife, to the more common, which is the bank insurance agent is a good customer of the bank, is an important part of our community, and so we want to continue to do business with that agent. There certainly are many community banks that have their insurance agent sit on the board of directors, and they buy their insurance with that director. I think that instance is a conflict of interest. I don't see it as a conflict of interest when the bank's insurance agency is providing the insurance. I think it's good business. Now, if is that agent qualified? Is the bank-owned insurance agent qualified to manage the insurance for the bank? That's another matter, but I don't see it as an ethical issue. I have, for a long, long time, felt that a board member providing insurance to the bank is a conflict for that board member, and to me, it's opening yourself up to. As a director and as a bank, I think it's opening you up to some scrutiny. I have been brought in to many banks where that is the situation, and one of the reasons that I'm brought in is that I can provide an independent review of the coverage and assure the bank that they are, in fact, managing this process correctly. There have been times that I've recommended that a bank move their insurance from their director or from their favorite insurance agent. But from an ethical perspective, I do have some concerns about a director providing insurance, just because there's some self-interest there. Some of the forced place brokers, this is another question, some of the forced place brokers are offering tracking services for customer insurance policies. Is this a good idea or not for small banks? So what we're talking about is when a bank does a mortgage on a particular piece of property, they require that the mortgage customer buy insurance on that property. So obviously the homeowner's insurance policy lists the bank as on the homeowner's insurance policy. Most banks track the insurance on their customers to assure that there is coverage in place. Now, we can buy different insurance policies to provide protection for that exposure, that particular issue. But it continues to be a part of banking that a part of the loan department is a tracking operation. I like to see banks move tracking to outsource insurance tracking. So instead of the bank tracking their customers' insurance, you've got a third party that's doing that review. There are several organizations that provide that service. The ones that I'm most familiar with are also selling force-placed insurance. So you've got a combination of an outsourced provider doing the tracking of your customer's insurance or the bank's customers, and if they find that there is no insurance, that they're placing coverage, they're force-placing coverage. There's some new regulations that have come into play with the consumer legislation over the last couple of years that make it tougher for banks to track their own insurance and meet the regulations that are out there. So many small banks are now considering outsourced tracking. It seems to make economic sense. The cost of the tracking service is reasonable when compared to the cost of labor and of the bank having people doing that tracking service. The Minotaur Group is a broker that I have used quite often for my clients in the lender asset protection realm. So they're providing forced place coverage, they're providing foreclosed property coverage, mortgage impairment insurance, and they can wrap that all in with the tracking service as well. They've got an operation that's set up and staffed to do that on a large scale basis. Lee and Mason is another insurer that does a fine job, insurance broker that does a fine job with tracking. So in general, I think that's a good way to go. Let me just take a look at my email here to see if I've got other questions that have come in, and we'll wrap this up. Okay. So let's spend a minute talking about the work that I do for banks. I am an insurance consultant. I do not sell insurance. I never accept fees or commissions from insurance agents or insurance companies. My personal investments do not involve any insurance. I don't own any stock in insurance companies. I don't accept gifts or gratuities from insurance agents or insurance companies. So the work that I do for my clients is on a fee-only basis. I always work on a flat fee basis. I don't charge by the hour. When a bank comes to me, we decide what the best course of action is. Do they need a review of coverage? Do they have a renewal coming up? And I provide the bank with a flat fee, a proposal showing a flat fee for the service that I'm going to provide. Flat fee. My fees range from, on the low side, for a relatively minor project, $2,200 to $25,000. So it all depends on what the individual bank is looking for and how I might be able to help. When an agent calls me to help them with a bank, I tell them I'm glad to work with their client, but I cannot work for the agency. I never work for insurance agency. The only time that there's an exception to that would be if a bank owns the insurance agent. And then I still want the bank a contact at the bank to be who I'm working with, because part of what we're doing is making sure that the insurance side of the operation is up to snuff and that they're doing things that they're supposed to be doing. So I want my report and my work to be with the CFO or CEO of the bank, but the bank obviously owns the insurance agent. Okay. I'm looking at my email, and I have not seen any new questions come in. So I think what we'll do is wrap this up. I'm very glad that you joined the call. Thank you very much. I hope that you found this interesting. Again, I've been blown away by the response to this. I've got a little counter that shows up on my computer screen as to how many people join, and the numbers are much more than what I thought. I'm very interested in feedback. Please feel free to email me your comments about this. I'm going to continue in some fashion to provide information to the agent community and the insurance community on what I'm seeing in the bank insurance world. Obviously, my websites are available to anybody who wants to visit them. I do not have gates set up to just provide information to clients. So check out my blog, check out my website. My main website is scottsimmons.com. And feel free to use that information again with attribution. I appreciate your time and your interest. Please let me know if you have any ideas on how I might be able to improve this session in the future, besides being better at technology. I appreciate your time. Thank you very much, and I'll notify everyone of future calls. Thank you.